Hi and welcome. Did you know that tennis legend Roger Federer played 1,500 matches and won only 54% of the points, yet ended up sweeping 80% of these matches? This is a great illustration of the power law principle of venture capital in action, which suggests that a few investments are responsible for generating a majority of the returns, which is why venture capital firms will invest in as many companies as possible to increase the odds of generating this supersized return.
But the power law has not always played out as anticipated in the venture capital universe. The downturn over the past couple of years served as a grim reminder that the power law alone isn't enough to deliver outsized returns. As risk capital returns gradually to India's venture capital market, it will be important to keep that lesson in mind. At Lightbox, our interpretation and application of the power law has always been a bit different. This has enabled us to weather ups and downs in the market better. Lightbox founder Sandeep Murthy explains how and why.
Hi Sandeep. Can you begin by understanding what the power law strategy is in the venture capital group?
Yeah, so actually I think before you even get to the power law, I think we should start by understanding what venture capital as an asset class is. So venture capital is a high risk, high return type business. And while I appreciate that stating the obvious, I think it's important to understand that that's what we're playing for. We're not in the business of low risk and moderate returns. We're in the business of high risk and high returns. And when you think about that as a business model and that as an approach, and you kind of go back in history and you look at all the funds out there and how they perform, in the timeframes of funds in general, for the timeframe of a venture fund, a 10-year period, venture funds on the average return about a 1x or 1.3x on average, and the median ends up being about 1x. And that's not great. And I think that 50% of the funds don't even return their base capital. And so the average strategy is a very difficult one. But actually, if you play it out in the long run, and actually when you look at it over a 25-year period, venture as an asset class actually ends up performing much better than even private equity. So that's great. And that's kind of the way why nowadays you see funds extending their lives, why you're saying, look, you need to play this out a bit longer, because over the long run, it all works. Now, the challenge is in the long run, we're all dead. And so now, how do we kind of balance that in the context? And you brought out Roger Federer as an example, and I think that business tends to look for sport for inspiration. And I think in this case, that the point made by that statement around what Roger Federer did is really to say that, look, you can win a few, but get massive returns out of it. And that's the idea of power law, right? To say that if my few investments are going to deliver outsized returns. And that's kind of how it's played out in venture overall, over time. And I think that's the rationale that's governed it. And a fair amount of that view comes from sort of how things have played out in the US.
When you look at India and when you look at the more structured markets when compared to India, we've maintained that India has inefficiency at scale. So how does the power law play out differently between these two markets?
Yeah, so I think when you think about where venture started in the US, and let's say venture started in the US to a large degree, it was a market that had already been organized, it had been urbanized, and suddenly you came along and you found technology penetrating. Now, technology was a strange thing. No one knew what it was going to do. No one understood, is the internet going to enable this? Is it going to do that? Are semiconductor chips going to get better at this or better at that? Is biotech going to work like this? Is it going to work like that? So you were taking bets on new technology. And essentially, you were saying, look, if I can build a better mousetrap for a market that exists, then that's great. I can create a lot of value by my new mousetrap doing something that nobody else can do. Now, the problem with that, or the reality of that, is that you don't know if that mousetrap's going to work or not, because it's all new technology. So what do? You take many bets. And what came out as a thesis or a kind of a statement for how it was done there was it was a spray and pray mode. So you say, look, I'll try this mousetrap, that mousetrap, this mousetrap, that mousetrap. I know it's a big market. One of these things will hit, and therefore I don't know which one, but when it hits, it's going to be massive. And that's, again, the power law at work there. So it worked out of the virtue of the fact that your mousetrap was so differentiated that that's what was happening there. Now, when you compare that to the realities of India, and in India, what we're doing is we're not creating better mousetraps. We're simply saying that, look, the markets exist. The markets need to be organized. They're operating inefficiently. Technology that has already proven itself in terms of, let's say, basic functions like search or a shopping cart or a digital payment are going to be more efficient ways to buy things than necessarily the cluster of random fragmented retail shops that exist. So I can now leverage the technology that already works. So I'm not looking for a new mousetrap. I'm simply saying the mousetrap works. The market needs to be fixed. Can I execute effectively to deliver a return there? And so that's the difference of the realities of the market. in spite of that, I would still argue that there's a power law dynamic that makes a lot of sense here.
So can we delve a bit into how Lightbox interprets the power law differently?
Yeah, so look, I think that when you look at the power law, it's all about ensuring that you're putting enough money in the companies that are going to succeed. Now, there was a study done by Stepstone and Primary Capital where they said the difference between good funds and great funds. A good fund was a fund that delivered less than 4x overall, a great fund that delivered greater than 4x. In both cases, both funds lost about 50% of their capital. The great funds, the great performing funds, were able to concentrate 40% of their capital, or 35% of their capital, into companies that delivered greater than 5x returns, whereas the good funds were only able to put 18% of their capital. So the dynamic is, can you ensure that you're putting more of your money in the things that are going to outperform? Now, it doesn't prescribe. There's no prescription that says you can only achieve this by investing in a broad range of companies. You can achieve this by investing in a small set of companies. But you still have to then ensure that you're concentrating your capital in the winners. Now, a concentrated portfolio in venture works because what we're looking at here is we're saying, in general, we want to invest in companies that are going to deliver, let's say, 7 to 8x. They have the potential to do that. Now, and this is not just my thought on this. When we go back and we look at what Peter Thiel said in the US as well, he looked at it and said, in a power law world, the only thing that matters are your home runs. You should invest in 8 to 10 companies that have the ability to generate a 10x return. Taking that a step further, AngelList went and did a study of their 1,800 companies in their system. And they said that if we constructed portfolios of 10 companies, and we said, here randomly selected, I think it was about 50,000 portfolios of 10 companies, and they said, look, what would the returns look like? They found that the median return was at about a 1.5x. But then the outliers generated up to a 19x. And I want to go back to that earlier statement. Venture capital is high risk, high return. We're in this business because we're trying to go for that 19x. Now, therefore, if I look at it and say, I can live in a world of a portfolio of 10 companies and still have the possibility to generate a 19x, then I should figure out how to do that well. When I take that a step further and I look at India, India as a market is not a market where you're building new mousetraps. You're a market where we are organizing the unorganized. We are operating with a landscape that is inefficiency at scale. So really what you're doing is you're saying, look, I know the technology works. I know the market is going to get organized. Can I apply this here effectively? And then really it's about, can I effectively execute through this? And I think that's where the concentrated approach works for us, is we're saying, if I'm investing in a Rebel Foods is a QSR business. It's a quick service restaurant. This market will have more quick service restaurants at scale. Now, can I execute that better than a traditional model? Absolutely. The cloud kitchen approach to it takes out a significant amount of cost. Now it's a matter of just executing it. We're not using any radical new technology. It's stuff that's there. We'll keep evolving as technology evolves, but it's a QSR business, but a better QSR business. Furlenco is a furniture business. We manufacture furniture, we rent furniture. There's a business model tweak, but at the end of the day, you have to know how to manufacture furniture, you have to know how to deliver it, you have to know how to bring it back, you have to know how to refurbish it. It's an execution risk. Now, I think we can manage execution risk. I think that you're not worried about new mousetraps, you're worried about just, do I have the right people, do they have the right approach, and therefore can we actually deliver the results?
Right. So, and how well has this interpretation worked at a fund level for Lightbox?
So I'll actually go back to 2005 when I first came and started investing in India. The portfolio that we created as a part of Sherpa Loan, from 2005 to 14, at that point in time, we returned the base capital to our original investors. And at that time, the portfolio's value was at about 8x. So it worked really well. We had made 10 investments. They included companies like InfoEdge, InMobi, Paymate, MapMyIndia, all companies that have gone on to do extremely well. And so I would say that, and by the way, if we held those same assets even further and hadn't sold for that 1x, I think we would have been closer to a 16x today. So this whole idea that in the long run it plays out really well was evidenced by that portfolio construction. But even in the time frame of that 10-year period, it worked really well. Now, I think over the coming year or two, you'll start to see some value creation or value unlock from InMobi, which will then drive a balance of that value creation. If I look at Lightbox Fund 2 that we have and the assets we invested in from 2014 on, there again, I would say that our liquidity has been a bit lower than we expected, but we're on track to seeing a 4x on that fund. So in general, the math has been working out really well for us. The challenge, quite honestly, has been that things have taken a little longer than expected over the last 10-year cycle, but that's life. And I think that's something that we'll have to adjust to. I think going forward, barring crazy macroeconomic issues. I think we now have a formula where scale exists in certain sectors. You're now starting to see adoption, organization take place at more rapid rates. So I think it'll all continue to get better and better and better as we go forward, because the opportunity set is still massive. And whether it's any segment, that the lack of brand penetration in many segments means that opportunity exists in many places.
So, what is the Lightbox playbook in managing the execution risk?
So look, I think that in general, we're going back to saying that we're operating in a market where we're organizing unorganized segments and not necessarily worried about radical new mousetraps that are going to change the world. So we are just focused on saying, look, Rebel is a better QSR. Bombay Shirt Company is a better apparel company. Furlenco is an alternate approach to furniture. So in all of this, these are models that people have created in the past. People already do sell food offline. You can go to anywhere down the road and you can go to a restaurant. That guy understands how to source a product, understands how to make it, understands how to sell it. So there's an understood approach to it. And there are people that have operated at varying levels of scale there. So what we've done is we've said, kind of similar to a private equity world, where we said, look, we're going to have a separate group that's going to be focused on portfolio success. Our portfolio operations team works with our companies, and that's all they care about. Ashish has joined us recently. He's got 16 years of experience in private equity doing this, 10 years before that at Marico. He brings this great knowledge of how to work with CEOs to help them understand how to get the most out of their business. How do you navigate the execution challenges in real world companies? We're not investing in two guys in a garage with a radical new idea that's going to change the world with just 6 employees and software that's going to scale indefinitely. We're investing in businesses where you have to find and hire the right people across the value chain. You have to have a deep network to know who to hire. You have to have an understanding of how to evaluate people, how to set the metrics in place. So all of this has been done. So this is not, we don't have to keep reinventing the wheel. So now when we're able to bring that expertise to our companies, they're now able to accelerate through the mistakes or avoid mistakes much faster and execute effectively. And we've seen that benefit over the last year and a half. And I think that's where you've seen, let's say, a NUA, for example, get to profitability and now grow at a great rate from that point forward. We're seeing more and more of our companies, CityFlow, which has now also found a great model in multiple channels, whether it's B2C, B2B, or B2G with the government as well. So enabling our companies to think in a different way and work with them more operationally, as opposed to perhaps the default mindset of a venture business is, let me go raise capital. Raise capital is not the answer. The answer is here, build a business that has value. And actually to build a business that has value, figure out how you can have an economic model that will ultimately get profitable. Because unless you get to profitability, you're an interesting idea, you're not a business. Once you find a way to get to profitability, now you're a business. Once you find a way to grow profitably, now you're an attractive business. And I think that's what our operational support is focused on. There's that aspect of it. The second pillar to that is corporate governance. I think that in any of these businesses, that the importance of ensuring that you cultivate these habits early on is really important. And so what we've done is we've created a corporate governance framework that says, based on the stage of your business, we will prescribe or assess and then work with you to ensure that your governance is done correctly. So if you're a Series A, Series B, Series C, there's different depths that you can go to. So we're going to work with you to make sure that that's done. And that should then ideally make you as a business better suited to execute correctly. And then tomorrow when you need to raise capital or perhaps be sold or perhaps go public, you're in a better place for all of that. So this is the operational support that I think can make a big difference to businesses.